You're listening to Indications by the Conference Board.
Hello, welcome to this episode of the U.S. Labor Market Roundup, our regular podcast series where we break down the monthly U.S. Bureau of Labor Statistics jobs report and identify key trends in the U.S. job market that business leaders should know about. We also unpack some of the relevant policy implications for the future workforce. I'm Elizabeth Crowfoot, Senior Economist at the Committee for Economic Development of the Conference Board. Today we'll be discussing the March jobs report, as well as the potential job growth associated with the Biden administration's proposed infrastructure package. But first, let me introduce my two regular guests and fellow labor market experts. First, Gad Lebanon, head of our Labor Markets Institute and a regular contributor in Forbes, and Frank Steemers, senior economist at the Conference Board, focusing on U.S. and global labor markets. Again, Frank, thank you so much for joining me today. So in many ways, this month's jobs report signals the labor market finally turning a corner. So let's get a sense of what this means. Overall, this really was a wow moment for the labor market recovery. U.S. employers added 916,000 jobs in March, and the unemployment rate declined to 6%, down from 6.2% in February. Payroll employment was further revised upward for January and February, adding an additional 156,000 jobs that weren't previously recorded. So to put this in perspective, job gains have essentially been doubling each month since the start of the year. The March employment gains were relatively widespread across the economy as well. Not only did we see strong jobs recovery in restaurants and bars, hotels, and arts and entertainment, but in other sectors as well, especially in state and local government, construction, manufacturing, education, and professional and business services. The labor force participation rate ticked up slightly, but when we break this apart, we see much larger improvements for women and minorities. Women who have been disproportionately affected by pandemic-induced job losses made especially large gains. Nearly 500,000 women rejoined the labor force in March, the largest increase since June 2020, while men have dropped out of the labor force for the third consecutive month. Men now make up the majority, or 51%, of the labor force exits since the start of the pandemic. We did see unemployment rates fall across most racial groups, but there are still huge disparities. Unemployment for white workers dropped to 5.4% compared to 9.6% for Black workers and nearly 8% for Hispanic workers. And the unemployment rate for Asian workers rose almost a whole percentage point to 6%. Overall, most of the decline seen in the number of unemployed persons was among those on temporary layoff. But while the recently laid off are being recalled to their jobs, the number of persons who have been unemployed for over 6 months continues to rise, which reflects the long-term labor market scarring that is going to continue to be felt among some groups. While the economy is still 8.4 million jobs short of pre-pandemic levels, with an accelerating vaccination campaign, aggressive fiscal stimulus, and increasingly confident consumers, we're clearly amid a hiring boom. So with that set up, let's turn to our labor market experts. Frank, I'll go to you first. I just mentioned that we're entering a hiring boom. What will that mean for job growth and the unemployment rate for the rest of 2021?
Yeah, thank you, Elizabeth. In terms of job growth, we expect more or less that there are going to be 4.5 more million jobs added to the economy this year, with the most jobs going to be added over the next couple of months. Especially in-person services, which have been especially hard hit because of the pandemic. If we look at some of these industries there, so think of hotels, think of entertainment, arts, there are still a lot of jobs that haven't returned. They're actually still more or less 30% below February 2020 levels. Of course, that was more or less the last data point before the pandemic broke out. So once that is going to open up, a lot of more jobs are going to be added to these industries in particular. So it could very well be that over the next few months we're going to see job growth something around 800,000 a month, and it might even reach 1 million. So then towards the end of the year, it's of course going to slow down a little bit because then the vaccine rollout has already been there across the country, and we will see less of a bounce back and then go back to more gradual growth rate over time. I think there are, of course, some risks to job growth, perhaps the rise in infection rates that we're now seeing across the US. At the same time, the most vulnerable have now already been vaccinated. So in these terms, I wonder if governors are still going to impose more restrictions, perhaps waiting a little bit to lift some of the restrictions. But I think that the vaccine rollout is really now driving the way forward in the labor market. So I think that is going to be the most important trends, the continuation of job gains in the in-person services industries, and then in particular in the accommodation, arts, entertainment industries, because there we haven't seen such a big bounce back yet in employment. In addition, next to the employment growth rate, of course, if we look at the unemployment rate, we're also expecting that the unemployment rate will just continue to go down over the next couple of months and go below 5% in the second half of 2020. And a year from now, the unemployment rate could very well already be close to around 4%. So I think maybe earlier than a lot of people, and including us, had expected a year ago, labor shortages, a topic that we often discuss before the pandemic, may be coming back sooner than we might have expected. And this is good for people who are working, because that means that more people are going to have a job. And when more people have a job, they're also going to often experience stronger wage growth again. On the other hand, for employers, it's going to be harder times because they are going to have more hiring difficulties and also more difficulties retaining workers.
Frank, and what do you think will happen to participation of workers in the labor market? The participation rate is still well below pre-pandemic levels.
Well, I think in terms of labor force participation, if we look at stronger employment growth, an employment rate that is going down, that should also encourage some people to rejoin the labor market. Over the last year, of course, people have been discouraged. It has been more difficult to find a job. Some people may have been fearful of returning to the labor market because of the virus that was out there. So when the economy is going to be stronger, labor market growth, especially in terms of employment, is going to pick up again. We do expect that some workers are going to rejoin the labor force and that also labor force participation is going to pick up again. At the same time, it may very well be that we're not going to return to the same labor force participation levels as we had before the pandemic. We've also seen this happening after other recessions. There's always some structural decrease, especially when we look at those without a bachelor degree. Those workers have dropped out after the 2001 crisis, the 2008 crisis, and it takes a very long time before they rejoin the labor force. In addition to that, we also see that older worker participation has actually continued to go down over the last months. So that can also mean that some people have already decided to go into retirement earlier than they might have expected before the pandemic. Maybe because they already have the chance to retire, because the retirement that they have is strong enough. At the same time, it could also mean that some of these workers just don't believe they cannot find a job anymore after the pandemic.
Thank you, Frank. That's certainly good news on the jobs front as we look ahead to the rest of the year. But I want to take a moment now to consider a longer-term view of potential job gains, and specifically those that may be spurred by the administration's proposed infrastructure package, which was announced last week. And I bring it up here because this infrastructure proposal is called the American Jobs Plan. So let's unpack this a little bit. As a quick primer, the American Jobs Plan is a $2 trillion spending package that provides funding for traditional infrastructure spending like roads and bridges, as well as investments in clean energy, R&D, workforce development, manufacturing, and the caregiving economy. A couple of studies, one from Moody's Analytics and another from the Georgetown University Center on Education and the Workforce, estimate that if the infrastructure proposal were to become law, the economy would add about 15 million jobs over the next 8 to 10 years. But Moody's analysis also finds that the plan would create only an additional 2.7 million jobs through 2030, on top of what would be created without it anyway. But ultimately, we're talking about jobs that would mostly be generated over the medium to long term. And according to the Georgetown University study, 75% of the jobs created would be for workers with less than a college degree. And among those jobs that would require just a high school diploma or less, about 2/3 of them could be done with 6 months of training or less. So this plan would potentially provide alternative career pathways with minimal training investment for workers with lower levels of education that have been hardest hit by job losses during the pandemic. And jobs would be heavily concentrated in certain industries, for example, in construction for maintaining those roads and bridges, in electrical vehicle manufacturing, so jobs to build more electric cars and to create more charging stations, in semiconductor manufacturing, which is in the longer term would help ease some of the future shortages of semiconductors. Jobs related to creating universal access for high-speed broadband. For example, workers needed to lay down fiber optic lines. And finally, jobs in the care industry, specifically in childcare and home care for the elderly and persons with disabilities. Those are just a few examples of some of the areas where jobs would be created. But one of the main goals of this infrastructure package is clearly to spur post-pandemic job creation. But infrastructure, like I mentioned, is a long-term investment. So, Gad, to pivot back to the short-term view of the recovery, what are some of the factors that point to strong economic growth for the rest of the year? And can we expect the recovery progress to be even throughout the country?
Thank you, Elizabeth. I think the main reason why we expect strong economic recovery in the next several months and the next year, actually, is I think the main reason is that in-person services will finally open up in a big way, maybe not fully recover, but mostly recover. So we're talking about travel, hotels, indoor restaurants, out-of-the-home entertainment, childcare services. So all of that will open up, and there are millions of jobs attached to that. The second reason, which is connected to the first, is that people will have the will and the ability to spend on those open services. So during the past year, US households accumulated much more savings than any other period in history because they didn't spend on those in-person services, but also because the stimulus plan and laws provided a lot of cash to households. So households have a lot of cash and they're willing to spend it, and now everything almost will be open for them to spend on. So we expect a major recovery in the economy and in the labor market. Whether or not we'll get to the recovery at the same time everywhere, that's probably not going to happen. One thing is that we know that there is a large variation in the country regarding vaccine hesitancy. In some areas, almost everyone is willing to get vaccinated, but in some areas it's far from it. So it could be that we'll get to herd immunity faster in some areas compared to others, and that may lead to differences in economic activity. The second thing is that not all industries will recover at the same pace, and in particular, things that are related to other countries are probably going to recover more slowly. So we know that in US is one of the countries that is where the vaccination campaign is moving the fastest. In other mature economies, it will probably take several months to recover after the US is already recovered, or for the pandemic to die a few months after it will die in the US. In emerging countries, it may take a year or two after. So that means that exports, US exports to other countries will still be impacted by the lack of complete recovery in other countries. And tourism is probably not going to recover much in 2021, international tourism, and we'll have to wait for 2022 and maybe beyond to fully recover. So, businesses that rely on those industries are probably going to recover more slowly.
Yeah, we definitely need to be monitoring the pace of the recovery, both in the US and obviously that pace in other countries throughout the world also impacts how consumers spend their money, how Americans spend their money as well. Well, that's all the time that we have for today. I've been speaking with Gad Lebanon and Frank Steemers from the Conference Board Labor Markets Institute about the main insights from the March jobs report. Gad and Frank, thanks again for joining me. And thanks to all of you for listening. Please join us for the next U.S. Labor Markets Roundup, where we'll be discussing the April jobs report. Don't forget to subscribe to both the Indications and Sustaining Capitalism podcast series from the Conference Board through your favorite podcast app. Thanks again for listening. I'm Elizabeth Crowfoot with the Committee for Economic Development of the Conference Board.
This has been Indications from the Conference Board.